It is Thursday, February 26, 2026. And today, we are we're going deep, like really deep into the engine room of the global advertising economy.
We really are.
Yeah, we are popping the hood on the trade desk.
That's right. Ticker symbol TTD. They released their Q4 2025 earnings report just yesterday afternoon, and there's just a lot to unpack here.
There really is. And, if you were watching the markets right after the bell rang yesterday, you might have felt a little bit of whiplash.
Oh, absolutely.
Because on paper, they beat expectations, they grew revenue, they're sitting on a literal mountain of cash.
Yeah.
And yet,
the stock took a dip.
right, the stock took a dip immediately after the news dropped.
It's the classic Wall Street disconnect,
Sure.
the whole what have you done for me lately versus what are you going to do for me tomorrow tension.
Exactly. So our mission for this deep dive is to bridge that exact gap. We need to figure out why a company that is seemingly firing on all cylinders is issuing what they call a prudent outlook.
Right.
But we aren't just going to look at spreadsheets today.
Right. No, we have to look at the philosophy. Because Jeff Green, the CEO, he spent a huge portion of this earnings call essentially declaring an ideological war on the walled gardens.
The Googles and Amazons of the world.
Yeah, exactly.
He definitely didn't hold back. We need to get into his argument about why cheap reach is a trap. And we really need to talk about AI.
Because everyone talks about AI.
Right, but the trade desk is claiming they're shifting the entire industry towards something called agentic AI.
Which is a massive shift in how money actually moves across the internet.
Truly. So for you listening, we've got the earnings call transcript, the press release, and the financial slide deck right in front of us. Let's start with a cold, hard reality, the numbers.
Let's do it.
How did they actually do in Q4 of 2025?
Okay, looking at the scoreboard here, revenue for the quarter came in at $847 million.
Which is up 14% year over year.
Right, and that number actually requires a little bit of forensic accounting, or at least some context.
How so?
Well, 14% sounds decent, but it sounds a little, mature, a little slow for a high-growth tech darling. But you have to remember where we were a year ago.
Oh, right. Q4 2024.
The massive U.S. election cycle.
Of course. Political ad spending in late 2024 was just off the charts.
It distorts everything. If you strip out that cyclical political spend to get a clean apples-to-apples comparison of their core business, the growth is actually 19%.
Okay, so comparing an election year to a non-election year is always messy.
Very.
So practically 20% underlying growth. That is solid. And they're profitable, like really profitable.
Very. Adjusted EBITDA was $400 million.
Wow.
Yeah, that's a 47% margin. Plus, they have about $1.3 billion in cash sitting on the balance sheet. And crucially, no debt.
Zero debt.
By traditional metrics, this is a fortress of a balance sheet.
So, okay, great underlying growth, huge piles of cash. Why did the market get the jitters? Why the dip? It really comes down to the guidance for right now, Q1 2026, doesn't it?
It does. They guided for revenue of at least $678 million.
Which is...
That represents about 10% year-over-year growth. And frankly, for investors who are used to seeing the trade desk post 20-25% growth, seeing a 10 on the page feels like the party is slowing down.
But is the party actually slowing down, or just a few guests leaving early? Because Jeff Green was very specific about why that number is lower.
He was.
He painted this picture of a tale of two economies.
That is the key insight here. It's not a systemic failure. It's a specific drag. He identified two verticals that are absolutely hammering them right now, auto and CPG.
Consumer packaged goods.
Right.
So we're talking about the big car manufacturers and the companies that make your toothpaste, cereal, laundry detergent.
Exactly. And these aren't small clients. These two verticals make up about 25% of the trade desk's entire book of business.
A full quarter of it.
Yeah. And right now, those industries are struggling.
This connects to the broader macro world, doesn't it? Green cited the pressures hitting these guys. Cost inflation, tariffs, and just the general cost of living crisis.
Exactly. If you're a big car company and interest rates are high, people aren't buying new SUVs.
And if they aren't buying SUVs, you don't need to run ads for them.
It's the easiest lever to pull. You pause the ad spend before you fire the factory workers. So the trade desk is fighting a headwind that is affecting 25% of their revenue.
But, and this is the aha moment for me reading through the transcript, if you look at the other 75% of the business, it's a totally different story.
Night and day. Medical, health, technology, business services, those verticals are booming. International markets are actually outgrowing the U.S.
Yeah.
So the thesis here isn't that the engine is broken, it's that they're dragging this heavy anchor called auto and CPG while the rest of the ship is trying to speed up.
That is a great way to put it. It's a localized storm, not global climate change.
Precisely.
Okay, let's pivot to the philosophy.
Yes.
Because Jeff Green loves a good philosophical argument, and this time he really went all in on the concept of objectivity. This seems to be the core of their pitch against the big guys.
It is, and it starts with his view on the current state of the internet. He says we're in a massive supply-demand imbalance.
Meaning?
Basically, there is more ad space, more supply available right now than ever before.
Right, because every streaming service, every website, every app has ads now.
Exactly, which means it's a buyer's market.
Okay, so if you are an advertiser, you hold all the cards.
Right. You don't just have to buy whatever is in front of you. You can be incredibly picky. You can decision your way to the best possible ad slot.
And this is where he draws the battle lines between the trade desk and Amazon or Google. He essentially called out the fundamental conflict of interest at those walled gardens.
It's the classic grading your own homework problem.
Yeah.
Let's look at Amazon. They have a DSP, a demand-side platform where they help you buy ads.
Right.
But they're also selling you their own ad space on Amazon Prime Video or their retail site.
So if I'm a brand and I go to Amazon to buy ads, are they really going to tell me to buy an ad on a competitor's site?
Yeah.
Because it's cheaper and more effective?
Or are they going to steer you toward Amazon inventory?
Exactly.
That's Jeff Green's argument. How can they be objective about what's best for you when they make significantly more margin if you buy their stuff?
Yeah.
It's a structural conflict.
And he didn't just speak in abstracts or theories. He dropped a specific case study that was honestly pretty damning.
Oh, the appliance manufacturer?
Yes.
Did you catch that?
I did. That was fascinating.
Mhm.
So a leading appliance brand ran a head-to-head test. This is like the Pepsi challenge of ad tech. They used the Trade Desk versus Amazon's DSP for connected TV ads.
And the results were not subtle.
Not at all. With the Trade Desk, they reached 70% more unique households. But here's the kicker. They did it at a 30% lower total cost.
Wait, let me make sure I had that right. They reached way more people and they paid way less money.
Yes. And in terms of hitting their actual campaign goals, like getting people to actually look at the product, the Trade Desk performed 6 times better.
6 times better. That is a massacre. It is. And Green uses that to prove his point. When you don't have a conflict of interest, when you don't own the inventory, you can just hunt for the best value across the entire open internet.
Because you aren't trying to funnel money into your own pocket.
Right. You are purely an agent for the buyer.
He also quoted a VP from Hershey's, Vinnie Rinaldi, who talked about the fallacy of cheap reach. I love that phrase.
It's a great phrase.
Because it feels like for the last 15 years, advertisers just wanted cheap impressions. How many eyeballs can I get for $1?
That was the only metric that mattered. But Rinaldi and Green are saying that era is over because cheap reach usually means junk ads that nobody looks at, or ads running on sites that are just clickbait farms.
Right. In a buyer's market, you shouldn't be hunting for the cheapest thing. You should be hunting for the relevant thing.
Exactly. But finding relevance, finding that one person who is actually in the market for a new refrigerator right now, that requires data.
And processing power. Which brings us to the buzzword of the century, AI.
It does. But I like how the Trade Desk is framing this. They aren't talking about generative AI making funny pictures. They are talking about Koa AI and the shift to agentic AI.
Agentic. Help us unpack that. What makes it different?
Think of agency. It means the ability to act. Agentic AI doesn't just analyze data and give you a report. It acts on your behalf. It makes decisions.
Green dropped a stat that blew my mind regarding why this is necessary. They process 20 million ad opportunities every single second.
Just think about the scale of that. 20 million times a second. The system has to look at an ad slot and decide, is this worth buying? Is it fraud? Is it the right price? Is it the right person? Is it brand safe?
No human could do that.
No team of humans could do that. You need an AI agent to do that filtering for you. They use it for identity probabilities, valuing impressions, forecasting spend, detecting fraud.
It's the entire engine.
Yeah.
But there's a counter argument here, right? There was a really interesting question on the call from an analyst, Jason Helfstein. He brought up what he called the super bear theory.
I love this question because it is so existential. Yeah.
The theory is, if AI agents become so good at buying stuff for us consumers, like if my AI fridge just notices I'm out of milk and orders milk, Does the brand of milk even matter anymore?
Right, if the algorithm decides generic brand A meets my nutritional requirements and is 10 cents cheaper, it just buys it. I never see the shelf. I never see the logo. So why would Coca-Cola or Chobani spend millions on branding?
It's the commoditization of everything fear.
Yeah.
And Jeff Green pushed back on this passionately. He basically said to buy Coca-Cola.
So he thinks the brand is the firewall against the algorithm.
Exactly. His argument is that agentic AI helps navigate complexity. It filters out the noise, but it doesn't replace the human connection to quality.
Because brands are trust signals.
Right. And he believes that even in an AI world, trust is the most valuable currency.
That is a comforting thought for the advertiser, certainly. He also mentioned that internally, their own engineers are using AI to write code, and productivity is way up.
So they are eating their own cooking on this one. They are. But let's look at the products they're building for clients with this AI, because they announced something called Audience Unlimited, which sounds a bit like a streaming subscription for data.
Yeah, let me explain this. Because historically, buying data in ad tech has been a nightmare. It's like ordering a la carte at a fancy restaurant where they charge you for the bread and water.
That is a perfect analogy.
You start with a base price for the ad, but then you say, I want to target women. Cha-ching, extra cost. I want to target age 25 to 40. Cha-ching, I want people interested in fitness. Cha-ching.
And suddenly your cheap ad is incredibly expensive.
Right. And that fear of incremental cost makes advertisers hesitant. They don't use the data because they don't want the bill to explode, so they make dumber buying decisions just to save money on data fees.
So Audience Unlimited fixes this how?
It's a buffet. It's a flat rate model. You pay one price as a percentage of your spend, and you can use as much data as you need. Yeah, you can layer on 40 different targeting parameters if that helps you find the right customer, and it won't cost you a penny more than the base rate.
That seems huge for adoption. If I don't have to worry about the meter running, I'm going to use way more data.
That's the bet. And the AI acts as the curator at the buffet. It automatically surfaces the right data segments for you so you don't have to hunt for them. It completely removes the friction from being smart.
They also talked about Deal Desk. This sounds like they're trying to modernize the old school way media was bought.
Yeah, the old insertion order.
Yeah.
Even in digital, a lot of premium deals like buying ad space on a specific news site are still done via handshake, email, and a PDF contract. It's slow and opaque.
And Deal Desk digitizes that.
It digitizes the workflow, yes, but more importantly, it uses AI to forecast the performance.
Before you buy it.
Exactly. Before you sign that digital contract, the system analyzes it and says, hey, based on market trends, this deal is likely to underperform, or this price is too high for this audience.
So it actively stops you from buying a lemon.
It brings data transparency to the dark market of private deals.
Now, we have to talk about OpenPath. Jeff Green used a metaphor I really liked here. He called it the canary in the coal mine.
This is one of their most controversial strategic moves. So OpenPath is the trade desk plugging directly into publishers. They are creating a direct pipe to the newspapers, the streaming sites, the broadcasters.
And who are they cutting out?
The middlemen. The supply-side platforms, or SSPs. These are the companies that usually sit between the publisher and the buyer, and they take a cut of the money.
Which obviously makes the SSPs hate them.
Oh, absolutely. It ruffles a lot of feathers. But Green's argument is that the supply chain is inefficient. There are too many hands in the cookie jar.
Right.
OpenPath charges a flat low fee, about 4.5%, to prove that it can be done cheaper.
And the canary metaphor.
The idea is that OpenPath is the benchmark. If OpenPath is the canary, and it thrives if publishers make more money and advertisers pay less using this direct path, it exposes the inefficiencies in the rest of the market.
It's a signal.
Yes. It says, hey, if we can do this for 4.5%, why are you paying 20% fees to these other intermediaries?
It's basically putting the industry on notice. Get efficient or get cut out.
Exactly. It forces the whole ecosystem to clean up its act.
Let's talk about where the growth is actually coming from. We mentioned the good economy sectors earlier. Retail media seems to be the absolute star player here.
Retail media is exploding. And it makes perfect sense. If the walled gardens like Amazon win because they have shopper data, The trade desk is building an alliance of every other retailer to compete with them.
They said they now have retailers representing over 50% of global sales in their marketplace.
That is massive scale, and they gave a great example from Cheerios in the UK.
I saw that. Walk us through it.
So traditionally, if Cheerios wants to run an ad, they might target people interested in breakfast or moms. It's a proxy, it's a guess.
But with retail media?
With retail media, they use data from actual retailers in the UK. They targeted people who actually buy cereal.
And the result?
88% more conversions.
Meaning 88% more people actually bought the product.
Yes, and they achieved a 7x better cost per acquisition.
7x better CPA. That is the difference between a failing campaign and a promotion-worthy one.
It is, and it shows why retail media is growing so fast. It replaces guessing with knowing. It's deterministic data. You aren't hoping they like cereal. You have a receipt that says they bought it last Tuesday.
And then there's connected TV, CTV. We have the 2026 Winter Olympics coming up.
Right. This is a watershed moment for streaming sports. NBC Universal is making the Olympics available programmatically on the trade desk. Yes. You can use data to buy the specific audience watching the figure skating final that matches your brand's target.
So I can target women aged 25 to 40 who buy luxury cars, specifically during the gold medal hockey game.
Exactly. You bring that decisioning power to the biggest stage in the world. It proves that even premium live sports are moving to this data-driven model. The days of spray and pray on TV are ending.
Before we wrap up, we should touch on the internal organization. Because growing from a $3 billion company to a $10 billion company is hard. Things break. What are they changing internally to handle this scale?
They did a significant reorg. They moved to what they call brand-first coverage teams.
How is that different from before?
Well, traditionally, you might have one salesperson hunting for new business dev, and another person managing the account activation. It can get disjointed.
Sure.
Now, they have unified teams dedicated to specific accounts. So one team owns the relationship with Coca-Cola or P&G from the first handshake to the final report.
That makes sense. It lines the incentives perfectly.
And it's working. They highlighted joint business plans, or JBPs. These are deep strategic partnerships with brands. Multi-year commitments.
And those are growing.
Rapidly. Those JBPs now account for over half their business, and the pipeline for them has doubled.
That is a very sticky revenue stream.
Yeah.
It's much harder to fire a partner than it is to fire a vendor.
Precisely. It stabilizes the revenue. And financially, they seem very disciplined. They mentioned headcount is growing slower than revenue.
Which is what investors love to hear. Operating leverage.
And they authorized another $500 million for share buybacks. That is a strong signal of confidence for management. They're basically saying, we think our stock is cheap right now, so we are going to buy it ourselves.
Okay, so let's synthesize this. We have a company that just beat earnings, but is facing a temporary storm in auto and CPG. They are doubling down on objectivity as their main weapon against Amazon and Google. They are rolling out AI tools like agentic AI and Audience Unlimited that actually seem useful, not just hype. And they are rewiring the plumbing of the ad industry with things like OpenPath.
That is the summary. It's a tension between short-term macro headwinds, which are real, and long-term structural innovation. Jeff Green is betting the company on the idea that objectivity wins in the end.
Because in a complex world, buyers won't trust a system that is rigged against them.
Exactly.
Which leads us to our final question for you, the listener. We are moving into a world where AI agents will make buying decisions in milliseconds, not just for ads, but for everything.
Everything.
In that world, trust is everything. So here's the question. Will the walled gardens eventually fail because their conflict of interest becomes too obvious to these smart AI agents? Or will their sheer size and data ownership keep them dominant forever?
It is the ultimate question of the next decade of advertising.
It certainly is. Take a look at your own company's data strategy. Are you ready for the agentic future? That is it for this deep dive into the trade desk. We will catch you on the next one.